Hey guys, welcome back to the Bitcoin Fortress podcast, the show focused on Bitcoin, sound money, individual sovereignty, and the accelerating breakdown of the fiat monetary system. Today is Sunday, July 12th, 2026. We are recording at block height 957731. Moscow time is approximately 1560 sats per dollar. And recommended Bitcoin transaction fees are sitting at just 1 sat per virtual byte across the board, low, medium, and high priority. Bitcoin is trading around $64,000 as I record this episode. That represents a meaningful recovery from the move below 58,000 at the end of June, but Bitcoin remains roughly 49% below the all-time high of approximately $126,000 reached last October. That tension defines the current environment. The price has been frustrating. Bitcoin has spent nearly a year moving inside the same broad range. The ETF complex has experienced persistent outflows. Bitcoin treasury companies are being forced to defend increasingly complicated capital structures. The familiar four-year cycle narrative has been badly challenged. The artificial intelligence stocks have captured investor attention. Bitcoin has lagged the broader technology sector, and the people who arrived expecting a quick continuation of the 2025 bull market have been forced to confront something much, much less exciting: time. A bear market is not always a vertical collapse. Sometimes it is a long period of boredom, uncertainty, and psychological exhaustion. But beneath the price chart, Bitcoin's political, financial security, and payment infrastructure continues to advance. This week, Bitcoin completed one of the longest price consolidations in its history. ETF flows showed signs of stabilizing after months of selling. Strategy sold another 3,588 Bitcoin to meet obligations associated with its preferred securities. Metaplanet began studying Bitcoin-backed digital credit products in Japan. A new version of the Clarity Act moved closer to release in the Senate. A four-year prohibition on a Federal Reserve central bank digital currency became law. The SEC prepared its first major crypto-specific rulemaking under Chairman Paul Atkins. Quantum computing risk moved from an abstract theoretical concern toward real institutional planning. Russia's largest private bank announced plans to enter Bitcoin trading and custody, and practical Bitcoin privacy tools continued moving into consumer wallets. The central theme of this episode is therefore straightforward. The price is consolidating, but the Bitcoin system is not standing still. Markets can remain discouraged while adoption continues. Institutions can retreat from price exposure while quietly building infrastructure. And Bitcoin can look stagnant on a chart while becoming more deeply embedded in the global financial system. And with that, let's get into the news. First up, market structure, price, and ETF flows. CoinDesk reported that Bitcoin has now spent more than 300 days trading inside the $60,000 to $70,000 price band. Glassnode data cited in the report showed that this has become the third longest period Bitcoin has ever spent within a single $10,000 range. That statistic tells us far more than simply saying that Bitcoin has moved sideways. This has become an extended transfer of ownership. Coins acquired by late cycle buyers, leveraged investors, short-term ETF holders, and weaker corporate treasuries are gradually moving toward buyers willing to accumulate through boredom and negative sentiment. Bitcoin bear markets can take several forms. A sudden crash creates fear, but it also creates obvious bargains. The price falls dramatically, people panic, leverage gets flushed out, and long-term buyers step in. A prolonged consolidation is psychologically different. It creates doubt. Bitcoin stays low enough to disappoint existing holders, but not always low enough to create the emotional urgency associated with a dramatic capitulation. Meanwhile, other assets perform better. Artificial intelligence stocks make new highs. Gold attracts safe haven capital. The broader equity market may recover while Bitcoin appears to do nothing. That environment tests conviction more deeply than a short-lived crash. It forces holders to answer a difficult question. Do I understand why I own Bitcoin, or was I simply expecting the price to rise? The consolidation is also evidence that Bitcoin's market structure has changed. At 64,000, Bitcoin has a market capitalization well above $1 trillion. It takes substantially more capital to move the asset than it did during earlier cycles. The entrance of ETFs, corporate treasuries, derivatives, structured products, and institutional trading desks may produce longer periods of balance between buyers and sellers. That could mean fewer clean four-year cycle patterns and more extended consolidations. The old Bitcoin model was dominated by retail enthusiasm and relatively illiquid markets. The new Bitcoin market includes asset allocators, hedge funds, option desks, public companies, preferred securities, pensions, sovereign entities, and ETF arbitrage. That does not eliminate volatility, but it may change the shape of volatility. The important question is therefore not whether Bitcoin has remained inside this range for too long. The important question is whether Bitcoin's underlying monetary characteristics have deteriorated. Has the supply cap changed? Has the network stopped producing blocks? Has self-custody become impossible? Has demand for an asset outside the fiat system disappeared? The answer to all four questions is no. The range is frustrating. It is not evidence that Bitcoin has failed. U.S. spot Bitcoin ETFs recorded more than $220 million of net inflows during an early July session, breaking a 10-day negative streak. Additional positive sessions followed, although analysts cautioned that more sustained inflows would be needed before declaring a durable reversal. This is significant because ETF flows have become one of the clearest marginal drivers of Bitcoin's price. In June alone, U.S. spot Bitcoin ETFs experienced approximately $4.5 billion in net outflows, their worst month since launching in January 2024. The ETF complex is a double-edged sword. During a bull market, ETFs create an enormous channel through which financial advisors, retirement accounts, institutions, and ordinary brokerage customers can gain Bitcoin exposure. Capital can move into Bitcoin without investors opening exchange accounts, managing seed phrases, or learning self-custody. But those same products create an extremely convenient exit. An ETF investor can sell Bitcoin exposure with one click. He does not need to move coins from cold storage. He does not need to send funds to an exchange. He does not need to confront the psychological weight of transferring asset he has personally secured. That convenience makes ETF capital more sensitive to momentum, portfolio rebalancing, and investment committee decisions. When the price rises, ETF investors can chase performance. When the price falls, they can exit just as quickly. The encouraging point is that Bitcoin absorbed billions of dollars of ETF selling and still held near the upper $50,000 to low $60,000 region. That suggests an underlying pool of demand exists outside the ETF complex. Native Bitcoiners continued buying, long-term holders remained active, corporations continued accumulating, and global buyers absorbed the coins being distributed by U.S. financial products. One or two positive ETF sessions do not establish a new bull market, but they may tell us that the most aggressive phase of institutional selling is beginning to fade, and that's worth watching. Analysts cited by the block argued that recent selling by Bitcoin holders may be consistent with the later stages of a bear market. QCP Capital noted that daily ETF flows had swung from negative 691.7 million session in late June to positive sessions of more than 220 and 260 million in early July. The phrase capitulation is frequently overused. Not every decline is capitulation. Not every transfer from a short-term holder to a long-term holder marks the final bottom, but bear markets generally end after sellers become exhausted. That exhaustion can occur through price or through time. Price-based capitulation happens when an asset falls so quickly that leveraged holders are liquidated and fearful investors sell immediately. Time-based capitulation happens when people simply grow tired. They stop believing a recovery is near, they lose interest, they sell because holding the asset has become emotionally exhausting. What is the saying? Markets either wear you out or they scare you out. Bitcoin's current environment contains elements of both. The price has been cut roughly in half from the 2025 high. At the same time, Bitcoin has spent months failing to produce a convincing recovery. That combination is capable of removing a large amount of speculative capital. From a long-term perspective, this cleansing process can be constructive. It reduces leverage, it lowers expectations, it transfers coins away from holders who require constant price appreciation, and it creates a stronger ownership base for the next phase of the market. But we should remain humble. A late-stage bear market is still a bear market. Bitcoin can remain weak longer than investors expect. The bottom is obvious only in retrospect. The responsible posture is not to declare victory every time Bitcoin rises several $1,000s. It's to maintain a disciplined accumulation strategy that does not depend on perfectly identifying the low, aka stay humble and stack those sats. Bitcoin recovered towards $64,000 during the week, but demand indicators remain mixed. CoinDesk noted that U.S. demand remained relatively weak even as Bitcoin recovered from its late June losses. The broader digital asset market also completed a third consecutive negative quarter in the second quarter of 2026, the longest losing streak since the 2022 bear market. This gives us a useful reality check. Bitcoin has rebounded. It has not yet demonstrated a confirmed trend reversal. A sustainable recovery would likely require several developments. First, ETF inflows would need to continue for more than a few isolated sessions. Second, Bitcoin would need to break decisively above the upper end of its extended trading range. Third, the market would need to show that demand is broadening beyond short-term traders covering bearish positions. Fourth, the Bitcoin treasury sector would need to stabilize. And fifth, macroeconomic conditions would need to become more supportive. Till those conditions improve, short-term rallies should be treated with caution. That does not mean selling Bitcoin. It means avoiding emotional swings between euphoria and despair. When Bitcoin rises from 58 to 64, the temptation is to declare that the bull market has returned. When it falls back towards 60, the temptation is to declare that Bitcoin is broken. Reminds me of the meme, we're so back, and then we're not so back. Either response is useful. Bitcoin rewards emotional stability. The accumulation phase is not the time to seek constant validation from the price. It's the time to build a position at prices substantially below the previous high while recognizing that additional volatility remains possible. A Wall Street Journal analysis highlighted a remarkable behavioral pattern. Although Bitcoin ETFs generated strong underlying returns following their 2024 launch, the average investor earned substantially worse results because of poor timing. Investors tended to add money after Bitcoin had already risen and withdraw money after it declined. This may be one of the most useful lessons of the entire week. An investment could perform well while the average investor in that investment performs poorly. The difference is behavior. When Bitcoin is rising, people feel safe buying it. Positive headlines create social proof. Friends begin talking about Bitcoin. Financial advisors feel more comfortable recommending a small allocation. Investors extrapolate recent gains into the future. When Bitcoin declines, the same people feel unsafe. The headlines become negative, the thesis appears less certain, investors begin to believe that selling will reduce their anxiety. The result is a familiar cycle. Buy after confidence has returned, sell after confidence has disappeared. Bitcoin magnifies this problem because its volatility creates intense emotional signals. The lesson is not that everyone should hold Bitcoin regardless of personal circumstances. The lesson is that an investor needs a process before volatility arrives. How large an allocation is appropriate? What would cause the thesis to change? Will purchases be made on a schedule? How much cash must remain outside Bitcoin? What time horizon is being used? Those decisions should be made during calm periods. A person who develops his investment plan while the market is falling will usually be governed by fear. A person who develops it while the market is rising will usually be governed by greed. Discipline means building the plan before either emotion takes control. Next up, strategy, digital credit, and corporate Bitcoin. The largest story in the Bitcoin corporate treasury sector was Strategy's disclosure that it sold 3,588 Bitcoin for approximately $216 million between June 29th and July 5th. The sales reduced Strategy's reported holdings to approximately 843,775 Bitcoin. The company said the proceeds would support preferred stock distributions and its dollar reserve. The amount sold was small relative to Strategy's overall holdings, but the symbolic importance was enormous. For years, Michael Saylor built the Strategy narrative around relentless accumulation. Bitcoin would be acquired, it would be held, and it would not be sold. That narrative was extremely effective during the bull market because it gave investors a simple framework. Strategy was not behaving like a conventional corporate treasury. It was positioning itself as a machine designed to transform fiat capital into Bitcoin. But a public company cannot operate entirely through slogans. Strategy has shareholders, creditors, preferred stock investors, regulatory obligations, contractual commitments, and distribution requirements. Once those liabilities exist, management must address them. Company's Bitcoin may be its greatest asset, but Bitcoin is also the most liquid asset available when obligations must be met. That is the central tension in Strategy's model. Bitcoin itself has no cash flow requirement, it has no dividend, it has no debt maturity, it has no preferred stock distribution, but Strategy does. The company has built a complicated capital structure on top of a simple asset. During strong markets, that structure can accelerate Bitcoin accumulation. During weak markets, the structure can require liquidity. The sale does not mean Strategy is insolvent. It does not mean Michael Saylor has lost faith in Bitcoin, and it certainly does not invalidate Bitcoin. But it does demonstrate that no public company could promise literally never to sell an asset while simultaneously issuing securities that create cash obligations. The never sell principle was always conditional on Strategy's ability to finance its obligations through other channels. Now the market knows that Bitcoin itself is part of the liquidity toolkit. That realization will affect how investors value Strategy's common and preferred securities in the future. The Wall Street Journal reported that Strategy recorded an approximately $8.3 billion second quarter loss connected to the decline in the value of its Bitcoin holdings and the accounting treatment surrounding its digital assets. The accounting loss does not necessarily mean Strategy lost $8.3 billion in cash. That distinction matters. But the number demonstrates how dramatically Bitcoin volatility can affect the reported financial statements of a company with such a concentrated treasury. Strategy is no longer a software company that happens to own Bitcoin. Economically, it is a Bitcoin finance company with a legacy software operation attached to it. Its financial results must therefore be viewed through several separate lenses: the market value of its Bitcoin, the amount of Bitcoin per diluted share, the cost of its liabilities, the sustainability of preferred distributions, its dollar liquidity, and its continuing access to the capital markets. Focusing on any single metric can produce a misleading picture. Gross Bitcoin holdings may rise while Bitcoin per share falls because of dilution. Preferred distributions may appear manageable while the market value of the preferred securities declines. The dollar reserve may increase because Bitcoin was sold. The company may remain solvent while common shareholders experience significant losses. This is why Strategy securities should not be confused with Bitcoin itself. Strategy offers a form of leveraged, managed, and capital markets exposure to Bitcoin that can outperform Bitcoin in favorable conditions. It can also underperform dramatically when the capital structure comes under pressure. An investor needs to understand which risk he is accepting. Strategy's preferred securities, including Stretch, represent an attempt to create what the company has described as digital credit, income-producing securities economically supported by a Bitcoin-heavy balance sheet. The model is innovative. Income-oriented investors receive a cash distribution. Strategy receives capital that can potentially be used to acquire Bitcoin, and the capital structure creates new financial bridges between conventional investors and Bitcoin. But innovation does not eliminate risk. The preferred investor must evaluate whether distributions will continue, how the distribution rate may change, whether the security will trade near par value, how much Bitcoin strategy may need to sell, when common equity issuance will remain available, and how the entire structure performs during a prolonged Bitcoin bear market. The market has demanded a substantial yield because the questions are unresolved. That is appropriate. Complexity should require compensation. A preferred security backed indirectly by a volatile Bitcoin treasury is not equivalent to a conventional investment grade bond. Strategy has created a new category of security. It now has to prove that that category works across a complete market cycle. The coming quarters may be more important to strategy's long-term credibility than the years in which Bitcoin rose and capital was easy to raise. Anyone can construct leverage in a bull market. The real test is whether the structure remains durable when the collateral falls, investor enthusiasm fades, and refinancing becomes more expensive. Metaplanet announced a joint study with Japanese partners to explore tokenized Bitcoin-backed credit products. The effort involves Metaplanet Securities, stablecoin issuer JPYC, and tokenization infrastructure provider Progmat. This may be one of the most important longer-term stories of the week. The first stage of corporate Bitcoin adoption was accumulation. Companies placed Bitcoin on their balance sheet as a reserve asset. The next stage involves using Bitcoin as collateral. That opens the door to Bitcoin-backed loans, tokenized credit, preferred securities, structured debt, corporate finance, and potentially entirely new savings products. Japan is an especially interesting market for this development. Japanese households and institutions have spent decades operating in a low-yield financial environment. Large pools of capital have historically been held in cash, deposits, and low-return fixed-income products. Bitcoin-backed credit could create a bridge between that conservative income-seeking capital and Bitcoin's scarcity. But we should distinguish carefully between Bitcoin and a Bitcoin-backed financial product. Bitcoin is a bearer asset, no issuer, no maturity date, and it doesn't depend on a borrower's ability to repay. A Bitcoin-backed credit product introduces counterparties, contracts, liquidation rules, collateral ratios, operational risk, and potentially tokenization risk. The underlying collateral may be pristine, the financial structure built around it could still fail. That does not make the experiment bad. It simply means investors must evaluate both the asset and the wrapper. One of the great ironies of Bitcoin's institutionalization is that the simplest asset in finance may generate some of the most complicated securities in finance. The 2025 bull market encouraged dozens of companies to imitate strategy. Some had legitimate operating businesses and thoughtful capital plans. Others appeared to use Bitcoin primarily as a way to attract investor attention and increase their share price. The 2026 bear market is beginning to separate the two groups. The relevant question is no longer simply how many Bitcoin does the company own? The more important questions are, how is the Bitcoin financed? How much dilution was required? Does the company generate operating cash? What are its debt maturities? Can it meet its obligations without selling Bitcoin? Is management increasing Bitcoin per share or merely increasing gross Bitcoin holdings? Does the business have a reason to exist if the market premium disappears? This distinction is healthy. Bitcoin does not need hundreds of weak treasury companies endlessly issuing stock to chase a temporary premium. It benefits from durable companies capable of surviving volatility without becoming forced sellers. The bear market is performing due diligence that investors failed to perform during the bull market. Bad structures are being exposed. Weak management teams are losing access to capital. Promotional strategies are being repriced. The survivors may emerge much stronger. Moving right along to policy, regulation, and financial control. CoinDesk reported that a new unified version of the Digital Asset Market Clarity Act could be released as soon as the coming week. The emerging draft reportedly combines work from the Senate Banking and Agriculture Committees and may include more than 70 pages of additional legislative text. Oh boy. I'm sure there's lots of juicy nuggets in there. This is meaningful progress nonetheless, but the legislative clock is running. The Senate's August recess begins after August 7th, and the approach of the midterm election season uh, will make bipartisan compromise increasingly difficult. The legislation still needs substantial Democratic support to reach the 60-vote threshold required to overcome a Senate filibuster. Major disagreements remain. Those include the treatment of decentralized finance, anti-money laundering requirements, regulatory jurisdiction, stablecoin-related rewards, and ethics provisions involving government officials and digital asset businesses. For Bitcoin, the Clarity Act is not about obtaining congressional permission to exist. Bitcoin will continue operating regardless of what Congress does. The importance of the legislation is that it could define how exchanges, banks, brokers, custodians, token issuers, and financial institutions interact with digital assets. Clear rules could reduce the ability of regulators to govern through enforcement actions and informal pressure. For years, digital asset firms were frequently told that existing securities rules were perfectly clear, while regulators refused to provide a workable path for compliance. A genuine market structure framework could improve that situation, but Bitcoiners should remain alert. A bill labeled Clarity can still contain surveillance, excessive reporting requirements, or protections for large incumbents. The title of the legislation is less important than its definitions. Does it distinguish Bitcoin from centrally issued tokens? Does it protect open source software? Does it preserve self-custody? Does it treat a non-custodial wallet developer as a financial intermediary? Does it expand financial surveillance under the language of consumer protection? Those details will determine whether the legislation represents real progress. The next several weeks may be the final realistic opportunity to pass the bill during this Congress. A provision prohibiting the Federal Reserve from issuing a central bank digital currency for 4 years became law as part of the 21st Century Road to Housing Act. The measure became law without President Trump's signature after the constitutional review period expired. This is an important victory for financial privacy, even though the Federal Reserve was not on the verge of launching a retail CBDC. A central bank digital currency would not simply be a digital version of physical cash. Cash is a bearer instrument. It can be exchanged directly. It generally does not require an account. It does not automatically produce a centralized permanent record of every transaction. A CBDC could be designed very differently. Depending on its architecture, it could give the state the technical ability to monitor transactions in real time, restrict specific purchases, freeze balances, set expiration dates, impose negative interest rates, automate tax collection, limit geographic use, or condition access to money on administrative rules. Supporters of CBDCs correctly point out that none of those features is inevitable. A CBDC could theoretically be designed with strong privacy protections, but political conditions change. Once the infrastructure and programmable state money exists, future governments inherit the capability. The safer system is one in which the government never acquires that capability. The 4-year prohibition is not permanent, it only runs through 2030. A future Congress could reverse it, but the law establishes an important principle. The digitization of money should not automatically mean the centralization and programmability of money. Bitcoin offers the opposite model. It is digital money without a central issuer. It is programmable at the edges through voluntary software rather than programmable at the center by political authorities. The difference could not be more important. The Securities and Exchange Commission is preparing a proposed rule known as Regulation Crypto, potentially as soon as July. The proposal is expected to address fundraising rules for digital asset companies and would represent the first major crypto-specific rulemaking pursued under Chairman Paul Atkins. This represents a meaningful change in regulatory posture. The previous enforcement-first framework created uncertainty. Companies were often told that existing rules applied, but were not given practical guidance on how to comply. The result was regulation through lawsuits, settlements, speeches, and shifting interpretations. Formal rulemaking is preferable because it creates an opportunity for public comment, legal review, clearer definitions, and more predictable standards. But regulation must distinguish among fundamentally different activities. Bitcoin is not the same thing as a company issuing tokens to finance a business. A stablecoin is not the same thing as a decentralized network asset. A custodial exchange is not the same thing as open source wallet software. A broker holding customer assets is not the same thing as a node operator transmitting public data. Treating all of these activities as one category creates bad law. A useful regulatory framework would focus on economic reality. Who controls the project? Who receives the money? What promises are being made? Does an identifiable management group determine the asset's value? Is customer property being held? Can the issuer alter the supply? Bitcoin is unique precisely because there's no company, management team, or issuer sitting at the center. Regulation should recognize that distinction rather than forcing Bitcoin into a framework created for centralized securities. The proposed United States Strategic Bitcoin Reserve continues to face legal, jurisdictional, and administrative obstacles. Surprise, surprise. Government Bitcoin holdings originate from different criminal and civil forfeiture proceedings. Various agencies may possess different legal authority over those assets, and some coins may be subject to victim claims or court orders. This is why creating a unified national reserve is not as simple as transferring Bitcoin from several government wallets into one address. There are questions involving Treasury authority, Justice Department authority, court-supervised forfeiture, congressional control of federal assets, victim restitution, budget rules, and the legal treatment of future seizures. The reserve remains symbolically important. A formal policy of retaining Bitcoin rather than routinely auctioning it would demonstrate that the United States views Bitcoin as a strategic asset rather than merely contraband to be liquidated. But Bitcoiners should manage expectations. Governments move slowly. Agencies defend their jurisdictions. Political announcements are easier than operational implementation. A genuine strategic reserve would require transparent accounting, clearly defined custody, rules governing future acquisitions and sales, publicly verifiable addresses or some equivalent audit mechanism, and a durable legal mandate capable of surviving a change in administration. Until those elements exist, the strategic reserve remains more aspiration than completed policy. But that does not mean it's meaningless. The fact is that the United States is debating how to hold Bitcoin rather than how to ban it, and that represents an extraordinary change. But the distance between a policy announcement and a functioning reserve is substantial. New Hampshire's Executive Council voted 3-2 against a proposal to have a $100 million Bitcoin-backed municipal bond. This proposal would have supported financing connected with Bitcoin miner CleanSpark and reportedly involved approximately 175 million of Bitcoin collateral. The rejection is disappointing for advocates of Bitcoin-backed public finance, but the proposal itself is historically significant. We've moved from a period in which government officials debated whether Bitcoin should be prohibited to one in which they are debating whether municipal debt should be collateralized by it. That is remarkable progress. The proposal appears to have failed primarily because officials were uncomfortable with the structure's complexity, volatility, and potential reputational consequences. That reaction is understandable. Public officials are naturally cautious about approving unfamiliar financial products, particularly when voters may not understand the risks. Bitcoin-backed bonds may nevertheless return. The concept offers several potential benefits. A Bitcoin holder can access liquidity without permanently selling the asset. A lender can receive over-collateralization. A public authority may facilitate economic development without relying entirely on conventional collateral. But these benefits depend on careful design. Collateral ratios must be conservative. Liquidation procedures must be clear. Custody must be secure. Price volatility must be planned for in advance. And taxpayers must be protected from losses. The New Hampshire proposal may have arrived before officials were ready. That does not mean the underlying idea will disappear. Financial innovations are often rejected before they become familiar. Reuters reported that digital asset companies and blockchain developers are beginning to prepare for the possibility that future quantum computers could compromise the cryptographic systems used to protect Bitcoin and other digital assets. Recent research has caused some estimates of the threat timeline to move forward, although the technology remains experimental and no existing quantum computer can currently break Bitcoin's cryptography. This topic requires balance. The quantum threat is not an immediate emergency. No one is currently using a quantum computer to derive Bitcoin private keys. Bitcoin does not need to be abandoned. There's no reason to panic, but dismissing the issue entirely is also very irresponsible. Bitcoin relies on elliptic curve cryptography for digital signatures. A sufficiently capable quantum computer running Shor's algorithm could theoretically derive a private key from an exposed public key. That's a very important point. That could allow an attacker, like address reuse, etc. That's why you don't reuse addresses. That could allow an attacker to sign unauthorized transactions. Not all Bitcoin is equally exposed. Some address structures conceal the public key until the Bitcoin is spent. Other outputs have public keys that are already visible. Reused addresses and older output types may carry greater risk. Again, what I mentioned earlier. Recent research estimates vary widely regarding how much Bitcoin could ultimately be vulnerable, which demonstrates the uncertainty around the issue. The encouraging point is that Bitcoin can be upgraded. Developers can introduce quantum-resistant signature schemes. Wallets can support new address types. Users could migrate funds. Exchanges and custodians could develop procedures for moving assets. The challenge is coordination. Bitcoin changes slowly by design. Any significant cryptographic transition would need extensive review, testing, wallet integration, hardware wallet support, exchange cooperation, miner and node adoption, and a plan for coins that do not move voluntarily. Post-quantum signatures may also be much larger than current signatures, which creates trade-offs involving block space and transaction costs. The responsible approach is therefore early research without premature panic. We should not wait until a cryptographically relevant quantum computer exists before beginning the work. At the same time, we should not rush immature cryptography into Bitcoin simply because alarming headlines generate attention. Bitcoin's conservatism is a feature. The goal is to prepare deliberately. BitGo announced a new quantum risk management capabilities for its institutional Bitcoin custody platform. The controls include risk scoring, identification of exposed addresses, and tools intended to reduce public key exposure within multi-signature custody arrangements. This is notable because it turns an abstract technical discussion into an operational custody issue. Institutional custodians must think in long time horizons. They manage assets for companies, investment funds, and clients that may expect to hold Bitcoin for decades. Those institutions need procedures before a threat becomes imminent. They must ask which wallet structures expose public keys, which addresses have been reused, how should coins be migrated, how should quantum preparedness be documented, what risks must be disclosed to boards, clients, regulators, and insurers? What happens if cryptographic upgrade requires customers to take action? BitGo's announcement does not mean quantum computers are about to break Bitcoin. It means serious institutions are beginning to treat quantum preparedness like any other long-duration security risk, and this is conservative. Resilient systems do not wait for disaster before planning. Bitcoin has survived because its ecosystem identifies risks, debates them openly, and works towards solutions long before they become urgent. And that is why we love open source software. On episode 753 of the Stefan Livera podcast, developer Dan Gould discussed the continuing rollout of the PayJoin development kit. PayJoin implementations are now appearing in wallets, including Bull Bitcoin and Cake Wallet. The technology can also use oblivious HTTP to improve network privacy. PayJoin improves Bitcoin privacy by breaking one of the most common assumptions used in chain surveillance. When an ordinary Bitcoin transaction contains several inputs, surveillance companies often assume that all the inputs belong to the same person. This is known as common input ownership heuristic. PayJoin disrupts that assumption by allowing both the sender and receiver to contribute inputs to the same transaction. The resulting transaction still looks like normal Bitcoin payment, but ownership is less obvious. This matters because financial privacy is rarely destroyed by one dramatic mistake. It is usually lost through patterns: address reuse, predictable transaction amounts, poor coin control, public withdrawal information, and repeated transaction structures. The average user cannot realistically master every privacy technique. That is why wallet defaults matter. Privacy technology has limited value when it requires expert-level coordination and complicated manual procedures. Embedding PayJoin directly into consumer wallets allows users to gain stronger privacy without becoming protocol engineers. That is how Bitcoin privacy will improve at scale, not because every user becomes an expert, because better behavior becomes the easy behavior. Another recent Stefan Livera podcast episode explored Radar, a project designed to integrate Bitcoin payments into a private signal-based messaging environment. The idea combines private communication with self-custodial payments using Bitcoin and Lightning-related infrastructure. This direction makes intuitive sense because payments are social. People rarely transfer money without context. They pay a contractor after discussing a project. They reimburse a friend after dinner. They support a creator after reading something valuable. They purchase an item through a conversation. Traditional payment applications already combine communication and payments, but those applications are centralized. The provider can monitor activity, accounts can be frozen, payments can be reversed, customer information can be collected. A private messaging environment with self-custodial Bitcoin payments offers a different model. Communication and settlement can happen together without requiring a central company to control the funds, which we like. That begins to resemble genuine digital cash. The most successful Bitcoin applications do not present themselves primarily as wallets. They may be messaging platforms, marketplaces, games, or creator tools with Bitcoin quietly embedded beneath the surface. Looking at you, Noster. Users do not always need to think about the settlement network. They need the application to work. Bitcoin adoption becomes stronger when Bitcoin is not merely an asset displayed on a trading screen, but a payment rail integrated into ordinary human activity. Next up, global financial infrastructure. Alpha Bank, Russia's largest private lender, announced plans to offer digital asset trading, custody, and depository services once Russia's developing regulatory framework takes effect. A rollout could occur in late 2026 or 2027. This development should be understood in the context of global financial fragmentation. Russia has spent years adapting to sanctions, restrictions on international banking, and reduced access to portions of the dollar-based financial system. Bitcoin does not eliminate those constraints, but it creates an asset and settlement network that does not depend on correspondent banks or another country's permission. Russia's government is not adopting Bitcoin because it suddenly embraced individual liberty or Austrian economics. No, no, no. States adopt neutral technologies when those technologies serve national interests. That is one of Bitcoin's strengths. It does not require ideological agreement. A Russian bank, an American asset manager, a Japanese corporation, and an individual dissident can all use the same network for entirely different reasons. Every major institution that develops Bitcoin custody and trading infrastructure makes the network more difficult to isolate. A bank may initially offer Bitcoin merely because customers demand exposure. Later, it may use Bitcoin as collateral. It may facilitate settlement. It may offer corporate custody. It may integrate Bitcoin into cross-border trade. Infrastructure creates optionality. The motives behind adoption may vary, but the network becomes more embedded. Global financial messaging network SWIFT launched a blockchain-based shared ledger with an initial group of 17 banks, including major institutions such as Citi and HSBC. The project is intended to support round-the-clock payments and respond to competition from stablecoins and blockchain-based settlement systems. This is not a Bitcoin story in the direct sense, but it is highly relevant to Bitcoiners because it demonstrates how deeply the existing financial system has accepted the need for continuous digital settlement. Traditional banking systems were built around business hours, intermediaries, batched processing, and delayed finality. Have you ever tried sending an international wire? If you haven't, I suggest you do. It just goes into an abyss and pops up a couple days later. The internet operates continuously. Global commerce operates continuously. Money increasingly needs to operate continuously. Swift's response is to modernize the existing system through a shared institutional ledger. Stablecoin issuers offer another model, tokenized dollar liabilities circulating on public or semi-public networks. Bitcoin offers a third model, a scarce bearer asset settling on a neutral network without dependence on a bank or issuer. These systems will likely coexist. SWIFT may improve institutional settlement, stablecoins may dominate dollar-denominated internet payments, Bitcoin may serve as neutral collateral and censorship-resistant final settlement. The important point is that the legacy financial system is moving toward characteristics Bitcoin demonstrated from the beginning: 24-hour operation, global accessibility, digital settlement, programmable interfaces, and reduced dependence on traditional banking hours. The difference is that Swift's ledger remains controlled by institutions. Bitcoin's ledger is controlled by consensus rules that anyone can verify. CoinDesk noted that Japan's efforts to encourage greater domestic investment could increase demand for assets such as Bitcoin and gold. Japan faces a difficult monetary environment, high government debt, long-term currency concerns, and a population accustomed to holding substantial savings in cash and deposits. Japanese investors historically operated under decades of low inflation and extremely low interest rates. That environment encouraged cash savings because the loss of purchasing power appeared manageable. But when inflation rises or the currency weakens, cash becomes less safe than it appears. The nominal balance remains stable. The real purchasing power does not. This is where Bitcoin's global relevance becomes clearer. Bitcoin is not merely a response to hyperinflation, it's a response to the gradual dilution of savings through debt, monetary expansion, and financial repression. A Japanese saver, an American saver, and an Argentine saver experience those forces at different speeds, but the underlying problem, well, it's the same. The monetary unit is managed for the needs of the state and the financial system, not solely for the preservation of the saver's purchasing power. Gold has historically provided one escape. Bitcoin now provides another. Japan may become an especially important testing ground for the combination of Bitcoin treasury strategies, Bitcoin-backed credit, and household demand for scarce assets. Moving along to the Bitcoin podcast universe. These were the themes of the week. Theme 1, better privacy, is moving into real wallets. And as we discussed earlier, Stefan Livera podcast episode 753 featuring Dan Gould had a detailed discussion of PayJoin. The important development is not simply that PayJoin exists. Bitcoin developers have understood the concept for years. The important development is that PayJoin Development Kit, or PDK, is making implementation easier for consumer wallets. Bull Bitcoin and Cake Wallet are among the wallets integrating the technology. That means users can gain stronger transaction privacy without manually coordinating multi-party transactions or running complicated infrastructure. The broader lesson is that privacy improves when it becomes part of the default user experience. Most Bitcoiners will not study every chain analysis heuristic. They shouldn't need to. Wallet software should help users avoid unnecessary information leaks automatically. That's not perfect privacy, but it raises the cost of surveillance and reduces the reliability of simplistic ownership assumptions. Theme 2, private money belongs inside private communication. Another recent Stefan Leverett conversation, which we talked about earlier, focused on Radar and the integration of Bitcoin payments into a signal-based private messaging environment. This points towards an important future for Bitcoin wallets. The wallet may stop being a standalone financial application. It may become one feature inside a larger communications platform. And that makes sense. Money is a form of communication. A payment communicates value, intent, obligation, and completion. Combining messaging and payments allows people to negotiate, transact, and settle without leaving the conversation. When that functionality is self-custodial and privacy-preserving, it offers a genuine alternative to centralized financial super apps. The legacy model combines communication and payments by giving one corporation control of both. The Bitcoin model can combine them while allowing the user to retain control. Theme 3, community custody can provide the middle path. Stefan Leverett's recent discussion of Fediment in South Africa also remains relevant. Bitcoin discussions are often framed as a binary choice: perfect individual self-custody or complete reliance on a centralized custodian. Fediment offers a middle ground. A community federation can distribute custody among several trusted guardians while providing fast, private, and inexpensive local transactions. This isn't trustless. Participants still rely on the federation, but the trust is distributed and socially grounded rather than concentrated in a distant exchange or bank. That may be especially valuable in emerging markets and circular Bitcoin economies where every user cannot immediately manage sophisticated self-custody. Bitcoin's end state may include several layers of custody: individual cold storage, collaborative custody, federated community custody, institutional custody, and small lightning balances used for spending. The correct structure depends on the user, the amount, and the threat model. And finally, theme 4, the Fourier cycle is being challenged. Actually, second to last, the Fourier cycle is being challenged. Another recurring topic across Bitcoin media has been whether Bitcoin's traditional Fourier price cycle is broken down. The old model was straightforward. The subsidy halves, new supply falls, the price rises, speculation accelerates, the market peaks, and a bear market follows. That framework described several earlier cycles surprisingly well. But Bitcoin is now much larger and more institutional asset. ETF flows, global liquidity, derivatives, corporate capital structures, macroeconomic conditions, and political events may now matter more than the halving force alone. The halving remains economically important. It reduces new issuance, but it does not create demand. If capital is rotating towards artificial intelligence equities, ETFs are experiencing outflows, and leveraged treasury companies are under pressure, reduced issuance may not immediately produce higher prices. This does not mean Bitcoin scarcity has stopped mattering. It means scarcity interacts with a more complicated demand environment. The Fourier cycle may not disappear completely, but investors should avoid treating it as a law of nature. Bitcoin does not owe anyone a specific price on a specific schedule. Another theme, Bitcoin finance is being forced to mature. Strategies Bitcoin sales and the repricing of treasury company securities have created a broader discussion about Bitcoin-backed finance. The key lesson is simple. Pristine collateral does not make every credit decision or credit structure pristine. Bitcoin has no counterparty risk when held directly in self-custody. Once it is used as collateral, wrapped inside a security or placed on a corporate balance sheet with liabilities attached, additional risks appear. Loan-to-value ratios matter. Custody matters. Liquidation procedures matter. Maturity schedules matter. Management matters. The underlying Bitcoin can function perfectly while the financial structure surrounding it fails. The current bear market is forcing the market to recognize that distinction. That is ultimately healthy. Bitcoin-backed finance will be stronger when investors understand the risks rather than assuming that every product associated with Bitcoin is automatically safe. And finally, theme 6, Bitcoin is increasingly becoming background infrastructure. The most important adoption may eventually become the least visible. Payments inside messaging tools, PayJoin inside ordinary wallets, Bitcoin custody inside banks, Bitcoin collateral inside financial products, Lightning inside internet applications. These developments may not produce dramatic headlines or immediate price movements, but they demonstrate Bitcoin moving deeper into the infrastructure of the economy. The final stage of adoption may not involve every person declaring himself a Bitcoiner. It may involve millions of people using applications whose settlement and savings architecture depends on Bitcoin without thinking about the underlying protocol every day. The internet became most powerful when ordinary people stopped talking constantly about internet protocols and simply used services built on top of them. Bitcoin may follow a similar path. Next up, let's talk about this week's featured Substack post, A Bitcoin Way of Life, Week 8. The broader purpose of a Bitcoin Way of Life series is to explore Bitcoin not merely as an investment or technology, but as a framework for living. Bitcoin changes how we think about time. It changes how we think about saving. It changes our relationship with consumption, debt, responsibility, and uncertainty. The fiat system encourages immediacy. Spend now, borrow now, consume now, push the cost into the future. Bitcoin teaches a different rhythm. It encourages patience. It rewards delayed gratification. It asks us to distinguish between what we want today and what may matter over the course of a lifetime. That lesson is especially important during a bear market. Bull markets make conviction easy. The price rises, social approval increases. Every purchase appears intelligent. Friends who previously ignored Bitcoin suddenly ask how to buy it. Bear markets reveal whether a person actually understands the asset. When the price falls, the external validation disappears. The holder is left alone with his reasoning. Did he understand scarcity? Does he understand why monetary debasement is structural rather than temporary? Does he value the ability to hold property outside of discretionary control of another institution? Is his time horizon measured in months or decades? The Bitcoin way of life is not built around checking the price every hour. It is built around becoming the kind of person capable of acting deliberately, remaining patient, and accepting responsibility. The objective is not simply to accumulate more. It is to need less from systems that do not have your long-term interests in mind. You can read A Bitcoin Way of Life, Week 8 on the Bitcoin Fortress Substack. Link in the show notes, along with links to everything else that we covered this week. Before we wrap up, I want to remind listeners I have now published 4 Bitcoin Fortress books. The newest book, The Architecture of Money, examines how the modern monetary system was constructed, how debt and monetary expansion shape society, and why Bitcoin represents an entirely different monetary architecture. The fiat system is built on discretion. Its supply can expand, its rules can change, its obligations grow through debt, and its long-term survival increasingly depends on refinancing, intervention, and monetary accommodation. Bitcoin is built on verification. Its supply is limited. Its rules are transparent. Its ledger can be audited by anyone. And ownership does not depend on the solvency or permission of a financial institution. The book goes beyond daily price movements and asks a more fundamental question: what kind of civilization emerges from the monetary system beneath it? You can find The Architecture of Money along with my other 3 Bitcoin Fortress books through the links associated with the podcast and wherever you normally purchase books. Well, folks, that's it for episode 224 of the Bitcoin Fortress podcast. The major lesson from this week is that price and progress do not always move together. Bitcoin has spent more than 300 days inside the same broad trading range. ETF investors have withdrawn billions of dollars. The digital asset market has completed 3 consecutive negative quarters. Bitcoin treasury companies are facing their first serious stress test, and strategy has been forced to recognize that the practical obligations of a public company are more complicated than the slogan, never sell. But beneath that weakness, ETF flows are beginning to show signs of stabilization. Congress is still working toward market structure legislation. The United States has temporarily prohibited a Federal Reserve CBDC. The SEC is moving from regulation by enforcement toward formal rulemaking. Banks around the world are building Bitcoin custody. Japanese companies are studying Bitcoin-backed credit. Custodians are beginning to prepare for quantum computing risk. Privacy technology is moving into ordinary wallets, and Bitcoin payments are becoming integrated into communications and internet applications. That is progress. Bear markets strip away easy narratives. They remove the tourists. They punish leverage. They expose weak structures. They separate direct ownership from financial engineering, and they transfer Bitcoin from people who require immediate validation to people willing to think in decades. The price may remain frustrating. The monetary system around us remains deeply unstable. The debt continues to compound. The currency continues to lose purchasing power, and the blocks continue to arrive. Bitcoin is doing exactly what it was designed to do. Stay humble, protect your privacy, hold your own keys, and keep building your Bitcoin fortress. And with that, I will talk to y'all next week. Bye-bye.